Adam Levine, SVP of Corporate Development at Fireblocks.
And I'm Sarah Downey, Global Blockchain and Digital Assets Leader at Lockton.
And this is a story about how Lockton helped us overcome the challenges to obtain digital asset insurance. There are three main challenges Fireblocks faced in going through the insurance process. The first, policies were really expensive, and the insurance industry was still getting to understand digital assets, let alone the Fireblocks business. The second, we needed someone to help navigate us through the underwriting process, which would prove to be an important validation. And the third was that our clients were demanding specific insurance programs that leveraged the fact that they were built on Fireblocks technology and was built for purpose.
Fireblocks isn't alone in confronting these risk challenges. Validating operational strength and building client trust are critical hurdles for any business that insurance can help you overcome. With Fireblocks, we help them build strong insurer partnerships, which then enabled us to build a cyber and tech E&O program and a cyber and crime program, both tailored to Fireblocks' specific needs. Cyber and tech E&O protects against cyber incidents and technology failures, while cyber and crime bridges the gap between cyber, which ensures the loss of data, and crime, which ensures the loss of assets, both critical components to ensuring any technology custody provider in the digital asset space. We also created a client insurance program for Fireblocks, ensuring their clients had comprehensive coverage in place.
Insurance has proven to be a critical component in building client trust, institutional adoption, and overall industry growth. We needed a partner that had deep expertise with unique risks, threats, and challenges in the digital asset space. Lockton has proven to be that partner.
Hello, everyone, and thank you for joining us. I am Sarah Downey, U.S. leader of Lockton's Professional and Executive Risk Group and Global Blockchain and Digital Assets Advisory Leader. The global regulatory environment for digital assets continues to evolve, which has significant implications for businesses operating in the space. During today's program, we'll provide an update on regulations around the world, and we'll talk about how you can build effective global insurance programs to mitigate your risk. Let's meet today's panel. I'm joined by Christian Davies, Global Head of Distribution and Innovation at Realm Insurance, Bob Williams, Lockton's Asia Pacific Blockchain and Digital Assets Advisory Leader, and Luke Spate, Lockton's UK and EU Blockchain and Digital Assets Advisory Leader. One quick note before we get started. If time allows, we'll want to take questions from our audience after we wrap up our main program today. You can use the comments function in your browser window to submit your questions at any time. With that out of the way, let's get started with a high-level look at how the regulatory landscape is shaping up globally. So we'll start with the US. In the US, the regulatory environment is becoming much more certain than it has been in the past. In the last 6 months, we've seen an array of executive orders, bills, and proposed bills. With the recent passage of the Genius Act, stablecoin-related regulation is clear. Next in line will likely be a market structures bill, which will delineate regulatory authority in a digital asset ecosystem between the CFTC and the SEC, and push the two regulators to work together to develop a clear regulatory framework. We are moving in the right direction in the US for sure. Christian, can you tell us what we're seeing in Europe?
Absolutely. So, of course, I think everyone kind of knows exactly what's happened in Europe with MiCA, or Mika, however you want to call it, being released. It went from an in principle to a fully launched, not so much a regulation, but more guidance across all the different jurisdictions. You've already probably seen a lot of upset around some of the stablecoin regulation that MiCA is implementing. That people, if they want to offer any of the stablecoins, even foreign stablecoins in Europe at all, they have to abide by the MiCA legislation. Tether very notably has turned around and said that they won't be doing that, and they're the largest by a considerably long way. There's the full delegated regulation, which was adopted to supplement MiCA, which was designed to specify standards for transparency by trading platforms. How bid, ask, order information must be published. That's something that's actually followed very traditional regulation on a lot of these online trading apps that you see today. And then another delegated regulation, which is setting out rules around market abuse. They're creating systems and rules for reporting, training, specifically addressing front running from some of the new ICO or token launches. One of the interesting things that's happened incredibly recently in the last week is ESMA has turned around and has stated that they believe they should oversee all crypto legislation for all of the European jurisdictions, which could, for all intents and purposes, render a lot of MiCA irrelevant. So that's something that everyone is watching right now. The French have also considered banning any crypto firms from operating in France if they have attained their licenses in any other of the European states. Obviously, that kind of, again, negates the MiCA regulation or legislation or guidance, which was supposed to allow cross-border passporting like most other financial services across Europe. And something that is very interesting for Realm. So Realm is licensed and regulated to capitalize and collateralize with digital assets. The European Insurance and Occupational Pensions Authority, or EIOPA, has proposed that insurers holding crypto should now have to hold 100% capital against those assets. Quite a punitive measure aimed at basically discouraging insurers from any kind of exposure to crypto and stablecoins. So a lot of people are relatively reluctant about some of the EU legislation unless they already have quite large existing EU client base.
Thank you. Clearly, there's a lot going on in Europe. Luke, anything you'd add on Europe?
I think it's overall sort of promising. There is, whilst there's ongoing challenges, there's still we're getting closer to regulatory clarity, at least more so in the EU than we are in the UK. I think the UK is still lagging behind Europe at the moment. We've got not much in terms of sort of true regulation yet, but progress is being made. There's been more focus over the past 12 months around consultations, but less around the action implementation of regulation. One thing that's been quite interesting and happened earlier this week was the announcement of a transatlantic task force for the markets of the future between the US and the UK. I think this would be quite an interesting opportunity for as the US has really set out a stall in terms of the development of regulation, for the UK to stay close and learn and hopefully implement some of those learnings into our regulatory system as well.
Yeah, I think it'll be great that the US and the UK created this task force and are going to work together. I think it benefits everybody globally, quite frankly. So thank you for that, Luke. Let's move over to Asia Pacific. Bob, what's happening there?
Across the region, we're seeing a number of sort of regulatory changes and more clarifications, I would say. But the sole intent is in the various nation states is to provide clearer and greater certainty and rules for each of those countries. The positions taken varies quite greatly depending on the country, with some actually restricting access and making it very prescriptive, very difficult, and others who are trying to sort of set themselves up, set their stall out to be that sort of hub, for a lack of a better word, and trying to bring digital assets into the mainstream part of their financial sector and services within the country or territory.
Thanks, Bob. Let's go a little deeper and look at some of the specific regulatory initiatives in each region, starting with the US again. The Genius Act, which President Trump signed into law in July, is a huge win for the digital asset ecosystem. The act provides the comfort that many traditional financial institutions have been waiting for and has already prompted more institutions to enter the stablecoin arena. Although its provisions are limited to stablecoin issuance, the bill is a first step towards greater regulatory clarity across the digital asset ecosystem here in the States, a significant development for the industry and those supporting it, including insurers. Another bill currently making its way through Congress is the Clarity Act. This is a market structures bill and is arguably the most important pending proposal for the much needed regulatory clarity in the ecosystem. The act, as currently drafted, lays out some guardrails for what falls to the CFTC versus the SEC to regulate. It also does instruct the CFTC and SEC to work together to come up with a clear regulatory framework for companies in the space to follow. Further, the recent report issued by the Presidential Working Group on Digital Assets specifically instructs the two regulatory bodies, again, the CFTC and SEC, to work together expeditiously to lay a clear framework in order to bring back onshore digital asset-related innovation that we had seen push offshore over the last few years. Another bill under consideration is the Anti-CBDC Surveillance Act. Some consider this to be unnecessary, as President Trump already signed an executive order prohibiting the creation, issuance, circulation, or use of a CBDC within the US. What comes after these pending bills will likely depend on the foundation the SEC and CFTC create, as instructed by what we expect to be a final version of a market structures bill. It's important to note that while we have seen a decrease in federal regulatory activity in this space over the last 9 months, we are closely watching to see how state regulators react. And there are really two different ways of thinking about state regulatory actions, in our opinion. One is that the states will ramp up regulation where they feel federal regulation is too lax. And the other is where states may dial back their activity while the implementation of the new federal regulation plays out a bit. So we're watching this area closely. So obviously these are some big developments which could have some implications for cross-border regulations. Christian, what does the Genius Act mean for the rest of the world?
I think that, well, realistically, it means clarity, right? Several years ago, everyone was kind of fearing and running away from the US, going, oh, I can't launch a token in the US in case I'm going to be embroiled in some SEC lawsuit. We're incredibly familiar with the variety, if not sometimes relatively spurious assessments of what could be a security and what could not be. And we have just seen an absolute flood of companies coming back to the US. They've given clear, crystal clarity. They've made it accessible. They're still regulating it, in my personal opinion, I think well, but they have truly opened the doors to innovation. It's a little bit like the UK used to be with fintech. The UK was in, and still is, probably one of the largest and most noticeable and notable innovative industries and markets for fintech. But the US has really put their flag in the ground to kind of lead the charge on the crypto stuff.
Thank you. And Bob, what's your take on recent developments out of the US?
From a purely Asia Pacific sort of viewpoint here, there's a great sense of hope that's come out of it, that this clarity is going to give surety to firms based out here to expand into the US, or to almost reopen into the US. And there's an acknowledgement from the region that there needed to be sort of that leadership coming from such a large market. And what's interesting is how we're seeing that actually play out in real time. We're seeing a number of M&A activity, and I mean that from firms buying each other in Asia who already had boots on the ground in the US, as a means to how they can ramp up services and production quickly, fastly, and efficiently, and coming together so that they can capitalize on the sort of beginning groundswell.
Thanks, Bob. Luke, can you tell us more about specific initiatives coming out of Europe?
Sure. Thanks, Sarah. So Christian briefly touched on MiCA earlier, and for those of you that aren't sort of too aware of it, it's the market and crypto asset regulation, which was implemented at the end of last year across the EU and enforced by ESMA and the EBA. It's essentially a regulatory framework for digital assets, such as asset reference tokens, which are kind of things like commodity-backed tokens, collateralized tokens, e-money tokens, such as stablecoins, and then sort of anything else, so utility tokens, and then as well as that, the services that support them, so exchanges, custodians, wallets, and they're then sort of bucketed as crypto asset service providers. Essentially, MiCA is aiming to harmonize across the rules across member states. So once authorized, a particular company entity should be able to operate and scale across the EU, in theory, without having to get any other regulatory approvals. What this really means for the end user, for the consumer, is better protection. So it's going to require the service providers to implement anti-money laundering and data security policies, procedures, and any entities that are going to be issuing tokens will also have to publish a white paper to begin with to set that out, and they won't have the approval to issue the tokens without doing that. Coming to stablecoins, the general consensus is no algorithmic stablecoins, but I think we've all seen how that's gone in previously, and going forward, there's a real push around stablecoins being collateralized one-to-one with real assets, as Christian mentioned earlier, and also there's an expectation that there's transparency around that, and that they're audited, and the end user and the consumer is able to have comfort around that. What is quite interesting though is that MiCA doesn't directly extend to sort of DAOs, DeFi protocols, and decentralized applications. If we then move to the UK, whilst there's been no specific introduction of regulation in the past sort of 12 months or so, HM Treasury has published a draft Financial Services Market Act order earlier this year. So this essentially looks at bringing crypto assets, including platforms, custodians, exchanges, brokers, staking providers, and stablecoin issuers under the scope of SFMA, which really brings them and integrates them into mainstream financial regulation. So it's a pretty huge move from a UK perspective. The FCA has also released a number of discussion and consultation papers around the broader crypto asset regulation. So specifically around stablecoin issuance, custody, and more broadly around prudential regime for assets as well. And then finally, we're seeing in October, which is quite interesting, sort of an embargo being lifted around exchange traded notes. So whilst we don't have sort of the ETF structure that there is in the US, it's sort of rumored that I think BlackRock are looking at listing an ETN on the London Stock Exchange as well.
I think adding to that, Luke, one of the interesting things, and I think it's also one of the first jurisdictions that has, the UK has stated that staking will not fall under any kind of scrutiny as well. They basically clarified the status, stating that it will not become a collective investment scheme under the certain definitions, which for all intents and purposes means staking is a go in the UK and free from any kind of big regulatory oversight.
That is big. Christian, anything else you want to add about the EU or UK, or should we move on?
Yeah, the UK has a massive opportunity at the moment to kind of sit between the absolute freedom of the US and what some people would deem as the overarching kind of over prescriptive regulation that MiCA has gone. So I think that everyone is very much watching this, but the UK has a history of protecting individuals, consumers. We saw that recently from the FinPro regulation that came out for crypto. All of a sudden, one day, the FCA turned around and said, you have to have a FinProm license to be able to advertise any type of crypto asset in the UK. And quite literally overnight, there was about 60, 70, 80 crypto companies that were put on a list that didn't have the correct financial promotion license to be advertising crypto assets in the UK, and they had a very limited amount of time to turn that around. And the FCA then started cracking down very rapidly on some of them. The other thing is there has been very notably when the first kind of custody regulation came out from the FCA, all of the big well-known custodians, some that were headquartered here, notably and famously Copper, they all started to go through the process of this. The FCA were so slow that a lot of those actually re-domiciled to other jurisdictions. Some went to Switzerland to get affirmative regulatory statuses. So the FCA, as of the 5th of September, have basically taken all this criticism on board and have committed to a promise of accelerating all regulatory applications.
Well, that's a great outcome, so thank you. Bob, tell us what specific initiatives we're seeing in Asia Pacific.
Yeah, of course. In the last few months, we've seen a number of shifts in the region, specifically in sort of Singapore, Hong Kong, and Australia. They're probably the three big ones. Singapore has created mandatory licensing for all firms providing what they call digital token services, even if they're not providing them to Singaporean clients. And this came into effect at the end of June last year. So prior to this, there was a lot of firms who had set themselves up in Singapore to provide these digital token services to non-Singaporeans. And this has caused a bit of a concern with the local regulator. So the Monetary Authority of Singapore, MAS, had made it extremely clear with this announcement at the end of June that they're only going to issue these DTSP licenses on extremely limited circumstances. And MAS has stated that the intent is to protect Singapore's sort of financial integrity and not allow firms with lower operating standards than what Singaporean reputation would normally deem. And they're saying these firms don't meet those standards. But what this has also done has led to sort of like a mass migration of firms that were quite well established in Singapore having to look to other territories. So a lot of them are moving to the UAE, be it Abu Dhabi or Dubai, or moving to Hong Kong. Apparently, there's been a real big focus on anti-money laundering, and that was their concern, and trying to protect retail users. Moving up north to Hong Kong, the SFC announced Policy Statement 2.0 back in end of June as well. And this is a complete sort of 180 from what we're seeing out of Singapore. Hong Kong is really trying to set out an intent and position that is a hub for the industry in the region. So within the policy statement, it includes licensing regimes for exchanges, stablecoin issuers, and custodians. There's also currently going through the legal reviews to support the idea of tokenization of real-world assets, things like bonds, and try to build out a growing ETF market. Down south in Australia, things are running a lot slower than they are in the other areas, but there is a growing requirement, and most firms who are seen as holding or custodying digital assets are expected to be holding an Australian financial services license. Last year, there was a lot of AML reforms under the Anti-Money Laundering and Counter-Terrorism Financing Amendment Act, which provided greater requirements on firms to comply and work with AUSTRAC, which is the local regulator. And interesting, like we're also seeing at the moment, is ASIC, who's the sort of financial regulator in Australia, is currently in the High Court, so the top court of the land, in a lawsuit. And depending on the outcome of this, will actually determine many basically financial services that are in the crypto space, are they actually going to be deemed to be true financial services under current Australian regulation? And therefore, all these crypto firms are going to be expected to hold AFSLs. As such, we're seeing a lot of these firms going through the process in advance of however this lawsuit lands, which is live.
We also know that they like fining people, don't they, Bob? I mean, there have been some monstrous fines from ASICs in the last kind of several weeks.
The thing with ASIC in Australia that a lot of people should sort of need to be aware of is Australia is a very highly regulated industry, and every aspect across every industry class. They act on a permission basis, not a rules basis. So there is a series of rules and they expect you to follow them. They're quite explicit with them. The positive to that is if you can get it right, you're away laughing. It's when you don't get it right, insurance becomes important.
Which is a great transition, because now we're going to tie all of this into insurance. So Bob, I'll direct this to you. We know that the regulators in Asia Pacific are focusing on insurance rules, licensing, and local insurance expectations. Why is that?
Well, Hong Kong is a really good example of regulators who have seen the value that insurance can sort of add to the whole process. So for them, insurance helps legitimize and provide an extra layer of assurance and due diligence to a growing industry class where there's an admission that as a regulator, they can't know everything. the high standards the insurance market kind of expects in order to provide cover at all allows for sort of, I'm going to use the term arms race, where good quality internal processes get better and better, and everyone wants to be that best client on risk. Alongside this, we're seeing in places like Australia, and even then to a lesser extent in Singapore, existing regulations that can just be expanded to include crypto services. And a lot of these regulations in Asia always included insurance requirements. So, for example, in Singapore and Australia, there's requirements on financial services firms to hold professional indemnity or errors and omissions cover. And with that, the expectation that they will be able to get that. Now, the problem we have with that area is the regulators are making I want to be polite here, it can be a little bit naive that they think that because a TradFi firm can go out and get 20, 30, $50 million of, say, errors and omissions cover quite quickly and quite easily, that same privilege is going to be extended to the sector, when the reality is there's a lot of specialism needed. And whilst we have some great underwriting partners like the team at Realm, there's not enough capacity that can kind of match that to that TradFi space yet. And that thinking that you can just go out and get a mainstream large alphabet insurer who's going to be able to write these things is just not the reality of the present. And that working with specialist firms and having that adjustment to potentially have lower limits and more targeted structural cover is going to have to be the way of the future.
And unfortunately, that's not an issue that's limited to Asia Pacific. I mean, we see it globally, right? There's expectations that firms in the digital asset ecosystem can get the same insurance TradFi firms can get, and it's just unfortunately not the case yet. So Bob, are we watching or expecting anything else from the regulators in Asia Pacific, and what about other regions?
So within Asia Pacific, there is a growing focus on tokenization of real world assets, especially in Hong Kong. They're really driving this conversation, but you're also seeing it out of Australia. So Australia has one of the largest pension funds sort of systems in the world. I think they're just behind Canada now. And there's this whole idea of diversifying and having tokenized assets to streamline processes, making things more efficient, all the things that all of us in the sector have been talking about for years. And with that, that is driving more focus and realization we need to adopt to this. But we're also seeing other things like wanting to extend to ETFs. ETFs are growing in popularity here in Australia, and most mainstream firms are starting to offer them as part of their service. Outside of the region, we're actually sort of on a global basis. We're seeing a lot more of a focus on the so-called, I think it's called, people say it's CARF, but the Crypto Asset Reporting Framework, which was developed by the OECD to allow tax authorities to have more information on crypto assets. And as we all know, as soon as tax gets involved, there becomes a greater realization of mainstreamness and acceptance of a system when tax starts being shared and collected.
Thank you. Christian, a lot of the regulations we're seeing globally are principles-based. Can you explain for our audience what that means and why we are seeing so many regulators take that approach?
Yeah, I think that it's an interesting one, right? Principle-based regulation is you need to follow X, Y, and Z and try and abide by them in this and to get this outcome, right? It's not that you have to do this in this way. So, you know, treating customers fairly is a really good example of a principle-based regulation. You know, you should endeavor to inform the participant in the clearest, best way possible within these certain guidance. You shouldn't mislead them. Your language should be clear. So it's not a case of you absolutely must do this in this certain font with this typeface, etc. It's about being kind of more broad, but clear. I think that's probably the best way of really kind of explaining it.
Thank you. So one of the common themes we're seeing is that insurance is increasingly being considered as individual countries flesh out their legal and regulatory frameworks for digital assets. Christian, why is this happening?
Apologies, Sarah, I cut out there.
Just curious why we're seeing insurance increasingly considered as countries are fleshing out their legal and regulatory frameworks.
Thank you. I think that realistically, we've actually had a very interesting one with Dubai, with VARA. If you look at a lot of traditional regulators, the FCA is a great example. They have mandated insurances as protection, right? It proves and provides that validity to industry. It acts as a backstop should things go wrong under regulated services. It provides the backstop for the user of that service and for the person providing that service. Insurance isn't necessarily there to provide comfort for absolute fraud and purposeful wrongdoing. It's for the moment that goes, oh dear, something went wrong, the process has failed, the regulation that we were looking at or the principle that we were trying to follow, we got wrong and we messed up. We're going to get fined. We understand that. Hopefully our insurance should cover that. It's for the moment where something goes wrong. Another good example of that is crime insurance, specifically for digital assets. A lot of exchanges, they have best practices in place. They put a huge amount of technology and security and a huge amount of investment in protecting these digital assets that they store online or offline. But sometimes things go wrong. And that is exactly what the insurance is there to do. It's to cover the it's gone wrong moment. The point being, in a lot of these regulations, they realize that there are users. They realize that there can be a huge amount of value associated with some of these transactions that ultimately can affect people if things do go wrong. So the regulator therefore looks to kind of put that stopgap, that fallback in place and making it mandatory, because insurance is also a good sense check for regulators, because if people can't get insurance, it does also offer that kind of like second line of defense for a regulator kind of going, why can't you get insurance? Should we also be looking into you maybe a little bit more, with a little bit more structure, with a little bit more of a deep dive? And it kind of gives the regulator that, oh, okay, they can get insurance. The insurers obviously get a lot of information. They do their own due diligence as a financially regulated instrument. We'll also provide the regulation around this. And yeah, we've had regulators come to us and say, we wish to regulate these industries. How would you advise us on setting a potential framework for insurance that would then give the credibility to the industry to grow, and also sense check our own decisions that we're making from a regulatory perspective?
Yeah, it's interesting because our message, I mean, this, our messages are really aligned. Like, we spend a lot of time here in DC talking to regulators and politicians, and we talk about why insurance should be part of the conversation. And two of our main points are that it acts as third-party validation, right? If a company goes through the underwriting process, and if they're unable to obtain insurance, that really does say something. But also, insurance is a great form of both investor and consumer protection. And I think people often forget that, but it really is such a great thing to have. Luke, I'm going to turn it over to you. Are we seeing any unrealistic insurance requirements?
Yeah, it's quite interesting to what both you and Christian were saying in terms of the conversations that we are having with the regulator. There are definitely certain territories around the world where it seems that there's been a bit more of a disjoint. It's fantastic that we're seeing more regulatory clarity and that there is more guidance around insurance with that. But within certain territories, I think Bob is more afraid of this than myself, but Hong Kong in particular, there's requirements around the percentage of asset values to be insured for exchanges and custodians. And whilst the idea behind that is sound, and once again, ultimately protects the consumer. There's a little bit of a disconnect in terms of where we are right now as an industry and the capacity we have as an industry to provide that level of cover to these entities. So whilst there's there has been a huge amount of development in the digital asset insurance market over the past sort of 10 years, and it continues to grow at rapid speed. We still can't quite keep up with where regulation is going in parts of the world.
So I think taking a step away from insurance just for a second, with all of these different regulatory initiatives happening around the world, Christian, what kind of questions are multinational firms asking right now?
Wow. So several of the questions that we're seeing are like, do our tokens or treasury stable coins trigger licensing in the EU or UK? What counts as significant under MiCA, and how would that change oversight? How do US stablecoin rules map to the EU and UK custody, reserve, and disclosure standards? What's my path to offer services in the EU by December without business disruption? How can I and what should I be doing to meet VARA regulations? I'm a DeFi protocol. Do I fall under the purview of MiCA? Yes or no? Lots of people are slightly unsure at the moment. There's a huge amount of questions that people are asking.
I'm sure there is. And Bob, in light of these regulations, it's important for companies to have effective global insurance programs in place. And there are a few different ways they can approach this. How can companies decide between global master programs and buying locally admitted policies?
So the pros of having sort of a global sort of central program is you get to control certainty of cover, you get to work with a single insurer about sort of setting things up. The cons, you can have some challenges with certain geographies, with certain territories having compliance rules involving things like what coverages can be in place, who can place them, payments and claims entering. So the EU is a famous one. If you're not an insurer or have some sort of mechanism to be an insurer, you can't actually pay a claim into the EU. But there's no right choice for a business. The nuance here is really, really, really important when structuring things. And I've never come across any two clients which are exactly the same. It's really an internal risk decision that you have to look at from both your risk appetite, but also what your firm does. Because a lot of the firms, especially in the digital asset space, they may not provide all services to all people in all places for a want, a need, and regulatory stresses. So they have to have a focus on sort of each country and what they're trying to achieve. So the one way is, yes, you can have a big global single insurer and do it all that way. That's very, very simple, but there's lots of ways that we can resolve this with using smaller elements, fronting programs, and it gets very technical, very complicated. But the first and key thing is you want to work with a broker or advisor who actually understands these in the various countries you work at. And then what I think is most important is working with an insurer who actually understands your risk first, and then we solve the compliance issue afterwards. Because it's all very well good to go to ABC insurance company, and they may be in every country in the world and can provide all these compliance stuff, and that's fantastic. But if they have no appetite to write your risk, they don't understand what you do, they give you bad terms, both in coverage and price, great, you're compliant, but you've bought something that's not worth it. Or do you look at going down what I consider the more sensible route, finding that right partner, and we'll name drop here the guys at Realm, we work with them all the time, finding that right technical partner, and then what we do is we go, right, we've solved the risk, now how do we meet the compliance piece? And we go down that path together.
And that actually leads nicely to my next question, Bob, which is also for you. What requirements in individual countries should companies be mindful of?
So some countries have very specific rules of what they call like non-admitted or foreign insurance. Every country uses its own terminology and language. And as I was saying with this one, we've got to get that balance right between following the compliance, but also knowing how to work around it. And making sure we work with those technical insurers who actually understand what it is that you do. So I want to use a couple of examples here, and I'm going to pick on a country that's close to home. In Australia, technically, you're not allowed to have what we call non-admitted insurance. It must be with a licensed insurer under the rules of ASIC and APRA, the two regulators here in Australia. However, there are exceptions you can do based on your risk profile, and a lot of digital asset firms, most of them, fall within that exception list. But it requires certain paperwork to be filed, and frankly, it's not difficult to do, but you need to make sure you're working with a broking advisor who knows how to do that, to make sure that you can find and get those specialist targeted insurers, and you don't wind up with just having something that's a piece of paper for the sake of it. Another extreme example is India, which has stricter, harder requirements. They do not allow under any circumstances non-admitted or foreign insurance. However, that doesn't mean that there's not a solution for that. It just means you have to be a little bit more creative, and we work with Realm on this at the time on building what, and this is an insurance jargon here, so I do apologize to everyone who's not from the insurance world, of setting up fronting programs and utilizing what we call a reinsurance deal. So you still get access to that technical capability, the people you know are going to pay the claims, the people you know understand your risk, but we've still met a compliant requirement. And it's about getting that balance right.
Bob, it's interesting you say that, right? Because it's not just India. Obviously, Dubai is another fascinating one, the UAE. So Realm actually saw this as Farah was setting up. And we opened an entity in the Middle East, in Dubai, specifically for this. And we got our policies approved and authorized by the Central Bank of the UAE, because the Central Bank of the UAE mandates any entity that is operating what's called onshore has to have an insurance policy that is issued by a local insurer. So we built a partnership. We actually built an entity to be able to facilitate that, which is now fully staffed. So yeah, it's a fascinating one. There's always ways around. Some of them can be incredibly labor intensive and capital intensive to be able to service those industries. But those are some of the unique requirements of some of these countries.
100%, and that's why it's really important and to focus on let's partner with the right market first. Let's get that insurer right, because you get someone like Realm who's gone, you know what, you want to expand into the UAE to expand. Well, we can service you there. Oh, you're wanting to expand into Europe. We know how to get that into Europe. We know how to manage those requirements, and then that goes from insurance being a spend to insurance being an asset, to insurance being a part of your business strategy, and then it becomes a thing where it is actually an enabler for business as opposed to this old-fashioned, oh, it's something that's on our balance sheet.
Yeah, agreed. Christian, as companies look to build global programs, what are some of the pitfalls they need to avoid, especially if they don't want to underestimate market limitations and coverage nuances?
Yeah, so one of the ones I see incredibly frequently is, just because you have a PO box in a country doesn't mean that is the legitimate way of where you should be buying your insurance. So for example, like if you're listed on the London Stock Exchange with a London headquarters, it's absolutely the best practice to have your insurance named as the London entity, not a random PO box that might be in Delaware. You would probably imagine most of your operations also run out of London as well. There are tax implications with insurances in every single jurisdiction you operate. So you have to be very conscious of what you do and don't do, and might inadvertently be in breach of quite a few local tax laws.
Luke, anything you'd add on that?
I think I'm just going to be echoing a lot of what we've said here, but we see this all the time as well, Christian, where you see you have clients who've worked with brokers and insurers who, for example, may have US exposure, but they have US exclusions on the policy. So really what this comes down to is working with a broker partner, an insurer partner who understands how to manage a global program and how to help you scale as you scale across territories.
Thank you. Christian, obviously businesses in the digital asset ecosystem have a lot of choices when it comes to both insurers and brokers. Why is it important for companies not to treat brokers and insurers as commodities?
So I'm fortunate. I am an ex-broker, and now obviously on the insurance side, there are very few markets that provide insurances for these emerging risks. Web3 and crypto being probably the major one. There are some that offer a single line of insurance. For crypto Web3, there are some that offer all of them, but very few. I'm talking maybe single digits who will actually start to write the primary insurance, set the terms. There's a very large broking pool, and we pretty much all operate on a first come first serve basis. So spreading your risk, right, going out to multiple brokers to try and get the best deal like you would traditionally do on your car insurance or home insurance, all at the same time, it basically comes across as incredibly disingenuous. This isn't like, you're not looking at just insuring a value of $25,000, and maybe some people on the call might have Ferraris, so the value of your car might be considerably more expensive. But we're not talking, we're talking about 5 million, 10 million, $20 million, $30 million, 50, maybe even 100, maybe more. So when you start to see these applications from insurance come from lots of different brokers for the same client, we all turn around and we operate on what's called a broker of record methodology. If we get the risk in first, it's blocked to that broker. If this piece of paper, which is an incredibly powerful piece of paper, comes in called a broker of records, we then believe that you have changed your partnership to another broker. What we do is we give between 48 hours and 6 working days period of grace to that prior broker, to that prior broking house, to contest. So that slows down any insurance procurement and any insurance decisions. And if you're in a rush to get it because a regulator maybe has said, you have to take that into consideration. For a carrier, you also need to understand that this is an incredibly long-term relationship. Sometimes people only want to just get the cheapest price. You're more than welcome to do that. It's your prerogative. Does it mean you're going to get the best cover? No, it doesn't. You pay, you get what you pay for all intents and purposes. And there are absolutely circumstances, and this is why having a broker is so powerful in the insurance procurement process, where claims might arise that might fall into, they don't necessarily fall into the cover you have purchased. The intent might have been there, but it wasn't portrayed. You didn't tell us. And there ultimately will come a time with the negotiation. It will fall down to relationship, premiums, intent, discussions, calls, and we might very well make the decision in line with the broker through mutual negotiation of this thing called an ex gratia payment, where we might deem that actually we will give X amount to this claims payment, despite the fact it doesn't necessarily fit 100% within the terms and conditions of that policy. So what we would always say, and we absolutely look at this, as do many other insurance carriers and brokers, is changing a market every single year is a sign of a company that does not value a relationship that they have, and they will ultimately end up with less favorable terms.
Yeah, when we talk to clients, we always talk about the value of a partnership, right? And with insurers, it is a true partnership, and there's so much weight that should be put into that. So totally agreed. Christian, when choosing an insurer to help build out global insurance programs, what should companies be looking for?
I mean, for starters, understanding their business would be a really good start, because this is not easy.
Agreed. Luke, similarly, what should companies look for when choosing an insurance broker?
Very similarly, how specialist are they in the industry? So does your insurance broker really understand the digital asset space generally, and the underlying technology and the nature of the businesses that operate in that space as well? I can only really talk to my time at Lockton, but where I found us to be particularly successful and really be able to help our clients is the fact that we have a global team. So we have the Lockton emerging asset practice, of which on this webinar we have sort of Sarah from a US perspective, myself in UK and EU, and obviously Bob from an Asia Pac perspective, where we have a group of people who really understand the industry and understand the insurance side of things and have the ability to work together globally, which means that in an environment where you have often quite complex business models, you can work and consult with them, but also as they scale globally, you have the ability to work cross border to ensure that each of our clients get exactly what they need.
That cross-border thing is massively important there, Luke, because like, you know, when you are running and managing global clients, like I'm based in London, and you know, we're a Bermudian headquartered insurance company with entities kind of all over the place. But we've had the privilege of working with Sarah, Bob in APAC, and Luke in London, all on the same client, but all need these different insurance policies in all these different locations. And it's important because each one has their own niche about understanding what that local legislation is, regulation, local policies, admitted, non-admitted, and have an understanding as well, because there are lots of people will turn around and go, we won't write it. Some people will go, we'll absolutely write it, but you'll end up with terms that no one is really sure where they came from or what they were, and they're on a wording that has absolutely no reference to crypto or Web3 in. So yeah, it's always good to have a good understanding of the client or the industry that you're trying to insure or trying to broker.
Agreed with you both 100%. So that's all for the main part of today's program. So let's now turn to your questions. As a reminder, you can use the comments function in your browser window to submit your questions at any time. So Luke, the first question I'm going to direct to you, but anyone else feel free to jump in. What has Lockton been recommending to clients? Purchasing standalone crypto coverage or adding coverage onto existing crime and specie programs?
Okay, thanks. So I'll answer this in the guise of sort of crime specie. I think it depends is a really sort of good starting point. So it depends on the client and the exposure. From what we do tend to see is that if you have traditional financial institutions who are have a portion of their business in the digital asset space, they will have a more traditional crime policy, for example, and with that it may be a case of working to amend the current cover to incorporate crime cover for them. From a specie perspective, we'd recommend a standalone specialist specie product, which is very much focused around sort of the cold wallet, cold storage element of custody, and then for sort of the more crypto native clients or clients in the digital asset industry, we'd often recommend a standalone crime with a crime form with a specialist, either with a specialist broker or specialist insurer, such as Realm. So ensuring, we've touched on this a little bit already, but really ensuring that the cover, there is firstly an understanding of your business, and then that the cover actually relates to the potential exposures your business has as well. Christian, I don't know how you'd answer it from an insurer perspective.
Yeah, it's so we actually created a product which is called difference in conditions, again more insurance jargon, because there are lots of big insurance policies out there, you know, traditional professional indemnity E&O, traditional crime, that won't take into consideration Web3 risk, D&O as well. So we created a difference in conditions where it literally drops down to cover the risks associated with crypto or Web3 that aren't covered in your already existing traditional policy. Because as we've all spoken about, you can't get 400 million of professional indemnity or E&O or D&O to cover crypto risk at the moment in the market. So you might still need that 300 million limit for your traditional D&O. So you can at least try and enhance your existing coverage with these difference in conditions. Ultimately, you really want to be looking at getting a standalone a standalone product that has specific verbiage in with specific understanding from specific markets that know how these things occur. Because Luke gave the example of specie. Traditionally, the specie market was designed for theft of gold bullion and, pieces of art disappearing in people's safety deposit boxes. It's incredibly different of how it has kind of progressed through a lot of education from brokers of what and how it can cover cold wallets and cold storage. So yeah, we always advocate for that kind of standalone insurance coverage.
Yeah, and I'm just echoing, I mean, really what you both said. It really is client specific sometimes too. Like right now we have we're working with two traditional financial institutions who have broadened into the digital asset space. One is going to keep or bring in wording in their crime program that does now pick up digital assets, because pricing wise, it's cheaper for insurers when they're looking at a combined policy where the assets that could trigger coverage are diversified. There's just less exposure from one specific area. So the pricing ends up being cheaper than if we were to build a standalone crime program that was specific to digital assets for this specific bank, versus we're working with another bank. And because of their own internal priorities, they've decided they want to build a standalone program for digital assets. So it really is so client specific, and you need to work with insurers and brokers who really understand what your priorities are. So just kind of echoing what was already said. The next question we have, I'm going to turn this over, Bob, to you, and I think to Christian. How would crypto, blockchain, and tokenization impact D&O insurance coverage, both specifically non-FI and non-crypto companies, but also maybe FI and crypto companies too?
I'll jump in first. We've seen a number of firms in the sort of nothing to do with the crypto space at the moment wanting to diversify their treasuries position. We've seen it from medical companies, hospitality companies, tech companies, some FIs as well, who are just wanting to move away from maybe not always having sort of bonds or having other form of vehicles in their treasury portfolio to including things in some of the more stable ones. So we say like Bitcoin, or got more riskier ones. Where it kind of impacts and that kind of element is sort of two-factor. If you're a publicly listed company, are you doing your disclosures that meet your requirements under whichever exchange that you trade upon? Are you meeting those disclosures? Have they been properly disclosed? Because that really can open you up to your investor book who may not agree with that strategy. And if they aren't made aware of it, we can get those kinds of claims coming in. But the second of all, and this is where importance comes from an insurer's perspective, is does your insurance policy actually have the right language for it? An example is we've had a firm that we recently picked up out of Asia, and they actually moved to Lockton because of this, is that as part of this strategy, and their shareholders were quite comfortable with it, their D&O policy actually defined what money and treasury products were in the D&O policy. And it was a prescribed list, and it went through and it named things like bonds and treasury vehicles and debit notes, but specifically it obviously didn't include crypto. So all of a sudden a side C claim that could have come in, because it was these specific language, it wasn't excluded per se, but it also wasn't actively included. And this is where you've got to start being really careful. If you're a traditional firm who wants to expand, wants to diversify your treasury situation, do you actually have access to people as your commercial D&O guy that you usually go to? Do they have access to the technical people to actually understand what the implications of this are? I don't know, Christian, if you've got more on that.
Yeah, I think that there are those specific lists in lots of people's wordings that will end up by excluding like a DAT, digital asset treasury. But realistically, anything crypto, blockchain, or tokenization that might be an inherent pivot from the norm of your business, you're going to run into two different problems here. One, if you don't tell your insurer, you're probably going to have a problem across all of your lines of insurance if something arises, because it is an inherent change of risk, right? It's a change of what you were traditionally doing when you were underwritten. Secondly, again, if you do that, if you have any shareholder right? If you're changing the trajectory of the company through crypto, blockchain, or tokenization, again, it can absolutely impact your D&O insurance coverage, because if you're not telling people, if you're not making it really transparent, as you said, Bob, like if you don't have shareholder agreement, or if you don't make them aware of these things, or any kind of investors, even seed investors, or non-public companies, you might have a problem. It's all to do with the trajectory of the company, and we've seen this. Like you mentioned, healthcare companies all of a sudden have a crypto treasury. It's like, where is that connection there? Well, we see the connection. We see it from varying the assets you have under those treasury portfolios. We have no problem with them. I think we've now bound about 8 of these companies looking at that kind of stuff, and we provide insurances specifically covering that. So yeah, but just people need to be aware, if you inherently enormously change the trajectory of what you were doing as a company from something vanilla to something a little left field, you're going to have a problem across multiple different avenues here.
So unfortunately, we didn't get to all the questions that were submitted, but that is all the time we have for today. Many thanks to Christian, Luke, and Bob for some great insights, and thanks to all of you for joining us. If you have additional questions, feel free to reach out to any of us following today's program. You can see our contact information on the screen now, and please visit our website, lockton.com, where you can find more thought leadership on digital assets and other topics, including our recent piece on digital asset treasury companies. Thanks again for joining us, and have a great day.